Hey, dealmakers, welcome to the show where it's all about financial freedom with real estate. Let's do this. What is your runway on this thing? Because if I'm going to do something, I'm going to do it, and I'm going to do it for 5 years, and I want to build wealth. That's what I want, and I don't want it to go away unless there's some black swan event, like a meteor hits the earth or something like that. I want to make educated guesses, and for those reasons is why I like multifamily, because the numbers are bigger, and I can grow those numbers with less effort, and I believe we have decades plus runway. Why do I say that? Because first of all, if I look back at how multifamily has performed over 50 years, yes, it has its ups and downs, but the defaults that have happened have been very, very low. The worst probably real estate recession we ever had was probably in 2008, well, at least in modern history, and it decimated the single family house market. Now, it definitely hurt the multifamily market, but it did not decimate the market. In other words, the defaults were for government-backed loans was only 0.4% of all government-backed loans, versus it was 4, depending on which report you read, 4 to 5% on similar government-backed, these are Fannie and Freddie loans, the 4 to 5%. So it's a staggering difference in the default rate. And the reason is because the risk is lower on a multifamily building because you have multiple tenants, right? If a building goes into negative territory, let's say it's 100 units, you'd have to go below 65 tenants for that thing to go negative in a lot of the cases. So the break-even point is very low for a multifamily. So what happened in 2008 is that, yes, rents were down, maybe occupancy was down a little bit, but they were still far above the break-even point, so they're still cash flowing. Now, should they have refinanced or sold in that time? Well, no, but they could ride it out. And so I like the way it performed going back in time, which makes this one of the more recession-resistant strategies. And I also like the way it behaved in COVID, for example, and even in the high interest rate environment. If you look at the high interest rate environment, if you have a fixed interest loan, is it a good time to buy, a good time to sell or refinance? No, it's a bad time to refinance or sell, but I can ride it out. And that's exactly what's happening right now. So I like that. I also like the outlook for multifamily. What I mean by that is that the affordable rent, there's no more affordable housing that's built. When I say affordable, I'm not talking about subsidized or Section 8. I'm talking about affordable as in it doesn't cost $3,000 in rent. I'm talking it costs between $1,000 and say $2,000 is what I consider affordable housing, because the average mortgage rate is significantly higher than that. So affordable rental property. Now, in our country, depending again which report you read, we're between 3 and 5 million housing units short. Let's go with 3 million. Still a big number. And there's really no solution to it. And why is that? It's because the cost of construction has skyrocketed, first of all, because of inflation, number one. Now the high cost of capital, interest, number two. And now we have unknown tariffs thrown on top of it. So the cost of construction is so high that developers have essentially stopped pulling permits. So if you look at the apartment permits, they're down like 75% over the last 18 months because developers can't make money anymore. And if they do develop something, it's got to be luxury Class A. It's the only way to make money. Therefore, no one's building Class B and C housing anymore. Now, I know this is age, Class B is age, etc. But I'm talking about from an affordability perspective. No one's going to build an apartment building and charge $1,500. So certainly not in Atlanta, maybe some in the middle of nowhere. So what I'm saying is there's no solution to the affordable housing problem yet. The population is growing, or people are migrating into warmer areas, whatever the case may be. Population is increasing, and the housing stock is not. What is that going to do to the rents, right? It's going to drive them up, right? And what will happen is it'll create an affordability crisis, which we already have, which is bad for Americans. There's no question about it, right? If I'm used to living in Class B, the rents go up and I can no longer afford Class B, where am I going to go? I got to go to Class C, right? Or I have to get a smaller unit. And so this is bad for Americans, but if you own real estate, it's actually good. And I don't, it's just free market forces that you could and should take advantage of. Yes, should you do the best job of providing quality housing versus being a slumlord? Yes, you should. But this is what's happening longer term in the multifamily space, and there is no end in sight unless something magical happens. I don't know. The government could print money and provide subsidies, and that's great, but that's going to create inflation, and we already know what happened with that. So I like the long-term outlook of multifamily. So you put everything together and you take those three lenses of scalability and passivity, and then the risk. And the risk is twofold. One, it's really what is the runway you have? At the end of the day, risk is what is the runway you have? Can you spend 5 years and really build wealth in whatever strategy you're thinking of doing or maybe have done in the past? And if not, then maybe you should reconsider and pivot your strategy. So those are the reasons I really like multifamily. Now, you're probably wondering, well, okay, Michael, isn't multifamily a kind of an advanced strategy? And it sounds like it is, but the truth is it's not. And the reason it's not is that you don't actually need 5 to 10 years of real estate investing experience to, quote, graduate to apartments. You can actually do it right now. If you've done a deal or two, fantastic. It's not required, but it certainly helps. And you don't need to save your way to real estate. A lot of people are trying to save and use a HELOC, and then they're buying a house or a rental, and maybe they're buying one the next year or 2 years afterwards. You don't have to do that either, because you can learn how to raise money. Literally within 30 days, you know how to raise money, and you're starting to talk to investors. And in 60 days, you start developing a very high degree of confidence. I know that because we work with students all the time, and 0 of them have ever raised money before. And then all of a sudden, they're raising $500,000, $600,000. Scott Todd recently did his first raise, and it was $800,000. And another business partners, Ryan and Russ, raised 2.1 on their first raise, right? So these are people who have W-2 jobs, or maybe they're business owners and they've never raised money before. They're like, oh, I can't raise money. I don't want to raise money. And yet they somehow do. So somehow it must be possible. What I'm telling you right now is you can raise money to buy real estate. And if you can raise money to buy real estate, you can buy more real estate. Now, I'm not going to talk about today because we talk about raising capital and building up experience and things of that nature in other podcast episodes. But for now, if you want to learn more about that thing, about apartments and kind of how syndications work, then go to thefreedompodcast.com, thefreedompodcast.com. There's several resources on that. The idea with this site is to kind of give you a next step into the world, the wonderful world of multifamily syndication. So on thefreedompodcast.com, there's something on there called Apartments 101, and it's a 45-minute training that introduces you to the world of multifamily syndications, kind of how they work, and things of that nature. Also, if you are ready to kind of get going and start scaling, but you really don't know how to do it right now, on that page also you'll have an ability to book a call with us and explore what it's like to work with us. So either way, either if you're just gathering it, and then also, of course, we have this podcast, we have a YouTube channel, blog post. If you're simply in the information collecting stage, then check that out and then make up your own mind. So hopefully I'll try to sway you a little bit on what your current path is. Want to help you get to that goal, financial freedom, as quickly as possible. And hopefully you have found this helpful. Catch you next time. So if you want to learn more about apartments and how you can overcome this lack of experience and how to raise capital and things of that nature, then check out my Apartments 101 Masterclass, because it covers all those things, gives you a great introduction into syndications and how to do the things that we just talked about here, how to get experience, how to build your team, even how to find those deals and how to raise capital. So check that out. The best way, the next best step here from the podcast is go to thefreedompodcast.com. That's kind of your next step. So you'll find Apartments 101 on that. It's thefreedompodcast.com. And on that page also, if you want to book a call and explore working with us, that's a great way to do that. If you're more of a passive investor, also go to thefreedompodcast.com if you want to learn more about real estate syndications and what it takes to invest passively in them. There's also a mini course on that as well that you can find. And again, if you're interested in finding out more or connecting with us about investing in our deals, then check us out on nighthawkequity.com. Those links are on thefreedompodcast.com. Sorry, that's the next step here. I don't want to confuse you. So the next step, whether you want to become a general partner or limited partner, is thefreedompodcast.com. So hopefully that'll provide you with some next steps. And then I'll talk to you on the next episode.